Welcome back to our channel. Today we're going to discuss the most common indicator in technical analysis, and that is moving averages. We have three common types of moving averages: the simple moving average, MA, the exponential moving average, the EMA, and the weighted moving average, the WMA. The difference between these three moving averages is that the exponential and weighted react faster to price changes in the market compared to the simple moving average. Here we have an example of the S&P 500 daily chart. We have the blue line, which is the 50 exponential moving average, and the red line, the 50th simple moving average. And as you can see, the blue line lies closer to the candlesticks compared to the red line. This means that the price will first hit the blue line before it hits the red line. Moving averages are what we call lagging indicators. So we cannot use these indicators in order to predict the future, where prices will be and so on. However, they are very helpful at determining trends, whether or not we are in a bull market or if the market is in a bear market. Furthermore, confirming reversals are also very important for traders. Whether we are going from a bull market into a bear market, or we are going from a bear market into a bull market. Long-term trends are determined by the 200 MA and the 100 MA. Medium-term trends are determined by the 50 MA, and short-term trends are determined by the 40 EMA or 20 EMA. Here we have a chart of the S&P 500 daily chart and a 200 simple moving average. And as you can see, when the price is above the 200 moving average, we're in a bull market. When the price is underneath, we're in a bear market. And when the price is again above, we're in a bull market and then in a bear market. This determines what kind of trend we're in the marketplace. Furthermore, when the candlesticks break the 200 moving average, it gives a sign that we're going from a bull market into a bear market, or from a bear market into a bull market, or from a bull market into a bear market. Now, this is not always the case. In most cases, the price will bounce off the 200 moving average or any other moving average, giving traders the optimal time in order to buy or sell in the marketplace. In this case, it will be the optimal time to buy stocks, currencies on the market in order to optimize income. Most traders will have several moving averages in their chart. The 200, 100, 50, 40, or 20 moving averages. Because these moving averages behave like barriers and they determine short-term trends, medium-term trends, or long-term trends in order to give the traders the possibility to determine where prices are going when we will have reversals. Thank you for watching this video. If you like these kinds of video, you're welcome to subscribe to our channel and hit the bell button in order to get a notification when our new videos will be released. Our next video will be about the Fibonacci retracement levels. Thank you very much.